Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to cover Tyson Foods, Inc. It's a subscriber request, part of my subscriber request series. I think this is going to be kind of fun because I haven't looked at this company in many, many years, and so I kind of enjoyed this. So I'm going to go through this with you, learning about the company, just as I would expect you to learn about the company if you decided to look at it. So I've never looked at this before, and I'm going to analyze it on the fly, if you will. Now, a couple of things. One reason I've not really been too interested in this company previously, if I go back in time and go back to what Tyson looked like, let's say from 2000 through 2009, you could see it was a very cyclical company, and I guess you could say it was primarily a chicken company. One thing that's fun with FastGraphs is I can go up here and I can go right into the company's website, and I can go into this Who We Are column right here, and I can actually look up the company's history and determine, get some background on what the company looked like historically. But importantly, as they tell you on the website here, Tyson has really morphed. They've gone from being a chicken company to what they call now pros and proteins. They, for example, they acquired, Hillshire Farm. They own Jimmy Dean, Ballpark. You can see they have quite a diverse level of brands here in what they like to call the protein sector. So it's a lot more than a chicken company now. I was kind of surprised to find that out. When you look at, where Tyson's has come from, you can see their history is actually quite fascinating. They were primarily a hatchery. Chicken was their forte, and you can see here that the company has changed quite a bit. They purchased Mexican Original in the 80s. They went beyond chicken and built this information center. They talk about the Hillshire acquisition, the Pierre Foods acquisition, and so you can see that the company has really morphed quite a bit since their early days as a chicken producer. But here's the point. When they were a pure chicken producer, I wasn't really interested in this stock for a couple of reasons. I want you to notice, number one is look at their dividend down here. Their dividend record was actually very poor. If I put the valuation reference up here for dividends, it was yielding about 1.5% at times, but the yield was also as low as 1% over most of these time frames. But here's the key thing. Notice that the company froze their dividend for all these years. There was no growth in the dividend. Then, I kind of have a sneak peek at the future here, the first year of the future. If I take that back one, this is what Tyson looked like. And I want you to notice, I'll just calculate performance right here for you. Performance wasn't too good. It was actually a negative rate of return over all these years from September of 1999 to September of 2009. A decade of what I would call negative or underperformance for the company, because notice how their operating results were very cyclical as well as very poor. Their growth rate was actually a negative 12.1%. But then that began to change in future years. You can see that start having some really interesting looking growth going on here. So I'm going to get rid of this here so you can see this clearly. Starting in really 2010, it happened first in 2009. But starting really in 2010 here, you'll see that the company really started to grow their profits quite nicely. And if you look at what Tyson has done in recent years, the earnings growth has averaged about 11.5%, and the company has really begun to really come into their own. So I'm going to now look at the company. If you look at performance going back, say, the last decade or so, when the company was in this growth phase, their historical performance here has outproduced the market. This is a time when the stock market did very well. Their dividend income outproduced the market. But I do want you to see that it's a function of the company's earnings growth. Now, I also want you to notice that this company has traded at a 15 PE, which is the orange line, quite a bit. But notice that it tends to be about a 10-11 multiple company, which would argue that at a 13 multiple, it would be slightly overvalued based on, historical normal PE ratios. So if I put that more normal, I'm going to use 12 here. If I apply the 12 PE, it'd be a full value here. It's in the valuation corridor, and it would give you decent rates of return going forward. But clearly, this company has changed. Now, the key is that I think is really important. The last dividend at 16 cents was in 2011. So I do want you to notice that they've grown their dividend almost 30% a year since 2011. clearly a sign that the company has changed and has morphed into more of what I would call a classical dividend growth stock. So the company has great growth going on here with earnings, and they also have great growth going on here with the dividend income. Now, I'm going to look at some other metrics here because I think it's very important. When I'm looking at dividend growth stocks, I like to look at operating cash flow. I talk about this quite a bit. And what I'm really looking for here, although I can get some valuation references here, I see that this stock normally trades at around 7.5 times its operating cash flow, and that's a little above that right now. That'd be the blue line on this graph, which would be a operating cash flow of 7.6. But the real important thing is, forget about valuation. What I really want to see is that cash flows are covering the dividend. And I also want you to notice, if you look at it from a numbers point of view, their dividend payout ratio has been really single digits. In the last couple years, it's up to the 13, 14, 15% range. So the company has a very low payout ratio of operating cash flow, which I think that's, very intriguing right now. And then I also want to look at price to free cash flow, because this really gives me the acid test of whether or not the company is covering their dividend. And you can see they have ample free cash flow to cover their dividend. And free cash flow is what's left over after what they spend to run the business. Once again, the dividend payout free cash flow ratio is in the 20% range recently, but it has ballooned up to that, but it's actually very, very low. And the point being is, very simply, there's plenty of cash flow here to pay the dividend. Now, if I'm going to go back to valuation references, I do want to take a look at, and by the way, I've lengthened the graph here. I do want you to see that this company really has changed. But back in the old days, they had good free cash flow coverage of the dividend, but they also had negative free cash flow coming into the recession. But let's move on and look at another valuation reference. I'm going to look at EBITDA here, or earnings before interest, taxes, depreciation, and amortization. And when I look at Tyson Foods relative to its normal price to EBITDA, which is about 4.8 times EBITDA, the stock looks very, very overvalued on that basis. And I want you to notice that it's correlated very nicely with that. But in these more recent years, as the EBITDA, like earnings did, and their EBITDA is a form of earnings, has grown, their EBITDA growth has been about 11%, and their normal price to EBITDA has been a little higher, around 5.5. So if I look at it from a forecasting point of view, it's based on its normal price to EBITDA. It doesn't look like it offers very much. But again, that's just one other valuation reference. From a standpoint of operating earnings, the company looks very interesting, and it certainly has been a great performer over the recent years now as the company has changed. So this is a stock that I guess I would conclude by saying is probably research worthy now. I do want you to notice, though, and again I want to reiterate, this is a company that you want to look at around a 12, 13 times earnings, and it's currently trading right at 13 times earnings. So this blue line is the normal PE, it's 12, and that's your midpoint of your valuation reference is how you should look at that. So, Tyson is an interesting company. It's a company that has changed. I haven't looked at this company in years. There's a lot of things to like about what's been going on here recently. And so I would say it's one that you might want to research a little deeper before you buy. I wouldn't recommend necessarily buying it today, but I certainly think it's worth taking a look at and maybe keeping your eye on. Anyway, this has been Chuck Carnival doing the subscriber request series on Tyson Foods. Thanks for watching, and if you like these videos, don't forget to hit our subscribe button. Thanks again.